What's up, millennials? In exchange for your time and hopefully a like as well, today we're going to talk about the valuation of View, which is a company that's going to be acquired by CF Finance Acquisition Corp, which so far is trading under the ticker symbol CFII. First, we're going to look at a very short introduction of View, and then we are going to take a look at their valuation. But before we do so, two things. First of all, Stock O'Clock. These are very short videos that I publish every single trading day right before the market opens with important news about the stock market. These are very short 1-minute videos. And the second thing is, never trust me, always verify me, right? I am not an expert, I'm not a financial advisor, I'm just documenting my journey here. And that means that, yeah, everything that I say could be completely wrong. I'm just a random dude on the internet. So View is a very interesting company and quite a refreshing company, to be honest with you. It's a company that makes smart glass. And yeah, as I said, this is very interesting, very refreshing, because so far we have been taking a look at very many EV companies, right? Like ChargePoint, Lion Electric, Luminar, Romeo, etc., etc. So this is a very different company. And I might actually do a longer video or even multiple videos about this company because I'm very interested, but for now I'm just going to give you a very short introduction. So as I've said, View has smart glass, and smart glass could be used for multiple applications. One of them being, for example, to have these smart glasses adapt to the sunlight instead of needing to use blinds, right? But you could also use them as a sort of smart board instead. You can simply write on them, you can have Zoom calls on them. So these can be pretty useful in the long term. And View is actually the market leader of smart glass. It's quite interesting to see that they have more than 80% of the market share right now. And personally, I really love this because I love first movers and I love industry leaders. Also, the revenue growth of View seems to be very promising. As you can see in this chart over here, the revenue growth from 2020 to 2025 is expected to grow more than 100% year over year. And View also seems to have an interesting board of directors, especially this guy, Tom Chung, who is an advisor at Softbank, which is a very big company that you might have seen in the news recently. Softbank actually invested more than $1 billion in View. Now, let's first take a look at the pro forma valuation of View. And as we can see in their investor presentation, they're using a base share price of $10 per share, which is very normal for SPACs. So that's the price that I put in my Excel sheet as well. And then they are going to have 214 million shares outstanding after the merger. So that's what I put over here as well. And that means that we already now know what the pro forma market cap is going to be, right? $2.14 billion, because you simply take the share price, multiplied by the amount of outstanding shares, and then you arrive at a market cap of $2.14 billion. Then we can also see that they have a certain amount of cash that's going to be on their balance sheet and a little bit of debt as well. So if we just take off that amount of net cash and net debt, we are going to arrive at an enterprise value of about $1.6 billion. So the pro forma enterprise value based on a share price of $10 would be $1.6 billion. The thing is, if we go into TradingView, we can see that the price went to $10.50 yesterday when the market closed. So if we then use that price instead, we can see that the market cap has, well, gone up a little bit to $2.247 billion. And that means that the current pro forma market cap based on a share price of $10.50 is about $1.7 billion. Of course, not a very big increase. Then the next step is going to be to look at the future enterprise valuation. And View and CFII, as I'm going to call them, have helped us a little bit out here. They simply took the 2025 EBITDA of $735 million, and then they applied an EBITDA multiple of 20 to 30x. Now, I'm not sure if these are very fair multiples. I'm not entirely sure, because they say that the range of multiples reflects data from selected publicly traded comparable companies. I would actually like to know which companies these are exactly, because I even wonder if there are comparable companies out there. Anyways, we're just going to roll with it, but maybe be a little bit skeptical with these EBITDA multiples, right? So they're saying, okay, we have an EBITDA multiple of 735 million. And we're going to apply an EBITDA multiple of 20x to get a low valuation, a future valuation of $14.7 billion, which is the number that I put in my Excel sheet over here as well. And then they say, okay, for the high valuation, we're going to take the same amount of, the same EBITDA number of 735 million and apply an EBITDA multiple of 30x. And that gives us a high valuation of $22.05 billion, which would be the high future valuation, right? And then if we are going to add an extra midpoint valuation, which is simply the average of these two numbers, of the low and the high valuation, we're going to arrive at a midpoint future enterprise value of about $18.4 billion. And now what we need to do is to discount this future enterprise valuation back to the present, right? So we take the future valuation. Let's first start with the low valuation of $14.7 billion. And then we apply a certain formula to get at a discounted enterprise value. We are first going to divide it by 1.2 because they're taking, as we can see in the investor presentation, a discount rate of 20% per year. So the 2 here stands for the 20% discount per year, right? And we need to do that to the power of 4 because they are using a 2025 EBITDA, and we need to discount it back 4 periods, 4 years to go to 2021, which is the year that we are almost living in. So we do that, and then we are going to arrive at a discounted enterprise low valuation of about $7.1 billion, which is the number that I've put in my Excel sheet and also the number that is in the investor presentation over here. So now let's do exactly the same thing with the high valuation, right? So we said a high future enterprise valuation would be $22.05 billion. We're going to apply exactly the same formula. So divide it by 1.2 because of the discount rate of 20%, to the power of 4 because of the 4 years to discount it back. And then we're going to arrive at a discounted enterprise value of about $10.6 billion. And then if we take a look at the midpoint discounted enterprise value, we would arrive at about $8.9 billion. Now this does make me wonder because $8.9 billion in enterprise value, but the current pro forma enterprise value of just $1.7 billion. I mean, I'm just wondering, why do SPACs undervalue the transaction so much? They might want to raise investor interest maybe, because it does seem to be the case that they do seem to leave money on the table, right? We've seen this a little bit with the Airbnb and the DoorDash IPO as well. Could also have to do with the compensation plans for the management team and the CEO, for example. But yeah, I'm not entirely sure why there is such a big discrepancy between the discounted enterprise value and the pro forma enterprise value. Anyways, the next thing that we are going to do is to take that discounted enterprise value and to add the amount of net cash, because we now have calculated the enterprise value, but we need to add the amount of cash to arrive at a fair market cap, if you will. So for the low discounted enterprise value, we said, okay, it's about 7.1 billion. So if we add the amount of net cash, 0.5 billion rather, we're going to arrive at a fair market cap of $7.6 billion. If we do the same thing for the high valuation of 10.6 and we add the amount of net cash, we're going to arrive at a fair market cap of $11.1 billion. And then the midpoint fair market cap would be $9.4 billion. And then the only thing that we actually need to do is just to take these market caps and divide these by the amount of outstanding shares after the merger, which we have said is going to be 214 million shares, right? So if you take this market cap of 7.6 and you divide it by the amount of outstanding shares, you're going to arrive at a price per share, a fair price per share of $35.52 for the low valuation. For the high valuation, it will be $52.08. And the midpoint fair price per share will be $43.80. All right, so there you go. A fair midpoint price per share would be $43.80. Before you leave, a few things first. First of all, for full disclosure, I bought shares of CFII because I think that we might be early to a very interesting SPAC play here. And for me, it's also refreshing to see a non-EV play. The second thing is, don't trust me, verify me, right? I'm not an expert, I'm not a financial advisor, I'm just documenting my journey, I'm just a random guy on the internet. And lastly, take into account that we have been looking at assumptions, right? We have looked at predicted revenue, predicted EBITDA numbers, and a certain EBITDA multiple. So if you change one of these numbers, the entire calculation is going to be entirely different as well. Cool, let me know in the comments what you think about this new SPAC play. And with that being said, thank you very much for watching this video, and I hope to see you in the next one. Bye bye!